Hello from the Dukascopy TV studio in Geneva. We are talking about tactical trading in a low-yield environment with Nicolas Rousselet. He is head of hedge funds at Unigestion here in Geneva. Welcome, Mr. Rousselet, to the studio. So, looking at the markets today, the bond yields are very low, sometimes even negative. So, how does this affect investors?
Right, very big effect. If you look at the yield across the world, I mean, we look at developed market sovereign bond. Many bonds are trading at below 1%. I mean, most bonds are very, very low yield, and it affects a lot investors because, well, bonds have been great for so many years. I mean, if you look at the next, maybe a next slide, you see that we've been in a declining rate environment for 15 years, and that has been great in terms of generating returns. But even if we don't look at the gains from a duration standpoint, bond investors were able to get quite a decent return with virtually no risk and with a very strong diversification power in their portfolio. So it was a great tool for any investor. And it was so good that now that it's not available anymore, I mean, the return is very low and the diversification power might not be as effective as it used to be, that will create a lot of difficulties for investors to allocate in their portfolios.
Mm-hmm. With this higher risk and certainly also challenge, where should investors deploy their money?
Yes, certainly. One thing we believe at Unigestion is that effectively active and constrained trading in liquid assets can effectively replace some of the bond allocation that people used to have. If you look at strategies that we call like tactical trading, so global macro, managed futures, or commodity trading, the purpose is to effectively capture the large movement in the market. So by capturing large movement in the market, if there is a significant reversal, there is a very good probability that the strategy will make money, creating a good diversification for investor portfolios. And the fact that the assets that people are trading actively are effectively very liquid, it allows to deploy very effective risk management, which means that when the loss starts, it can be cut very quickly and hence preserve capital, which is very close to what an investor in bond will expect, which is a very strong capital protection and I would say quite a good diversification power.
Mm-hmm. Are there also negative sides in this tactical trading? Well,
the return can sometimes be disappointing if the market conditions are not very good. In the worst years that we have experienced, is something like 2012, 2011, which were very tough years for tactical trading, where effectively the volatility was very low, so very few opportunities to capture large moves, but also the correlation between assets was very high, so very little different opportunities, only one big opportunities. I think at the time we were calling that the risk-on, risk-off environment. Then the return can be disappointing. So it's a strategy that on the long run is quite effective. And the biggest danger of the strategy, I would say, is the investor himself, which can lose patience and lose the benefit of the strategy sometimes at the worst time. What's interesting right now also is that this condition, which was low volatility and high correlation across assets, has disappeared. We've seen assets decorrelate to each other a lot in the recent years, I would say since 12, 18 months. And that has allowed managers in tactical trading to deploy capital more efficiently, to be less prudent, I would say, in their capital deployment. And we see also the volatility coming back, especially in the currency world, as the central bank are extremely active, and clearly countries are starting to engage in a currency war. This creates large movement. One of the largest moves we've seen is the euro-dollar, which was very, very strong, and that's a move that has been very well captured by tactical traders.
Mm-hmm. So this cross-market correlation, will it still go on? What is your assessment?
We expect effectively that the decoupling of central bank monetary policy, so with the US being more on the side of potentially tightening or at least not engaging into a QE compared to the Eurozone or Japan being very QE-oriented, will create a different flow of money across the world. Instead of having the dollar flowing from the US to the rest of the world, having more the dollar flowing back to the US, that will create certainly more volatility in the markets. And that should be very beneficial for such strategies.
Nicolas Rousselet from Unigestion, thank you very much for being here today.
Thank you.
And thanks for watching. Do make sure to keep clicking back on the Dukascopy TV website for latest updates and exclusive interviews. Have a great day and see you next time.